JJ, the CPA is here. Let's go, let's go. Yeah. Money, 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 money. You know what it be. Tell them all I do is work, cause money never sleep. Yeah. You never met a CPA quite like me. Nah.
JJ the CPA here. Hope you're doing well. Thanks for joining us today. We're live. This is my weekly show. I am Joshua Jensen, CPA. I'm a practicing CPA here in Oklahoma. I'm in the trenches every day advising clients. I'm not a YouTuber in the sense that I don't do this for a living. Honestly, I do it for fun. Today, we're going to cover a number of issues. I'm going to walk through my agenda, top 10, talk about paying less in taxes. How do we tax LLCs, give you some client advice, throw in a couple other things. But before we get rocking and rolling, thanks for tuning in for JJ the CPA's Small Business Toolbox.
The combination to money making, we got this. JJ the CPA is the master locksmith.
All right. Hey, thanks for coming on live with us. And if you're catching us later, thank you so much for that. We had a great turnout in the prior week talking about some banking issues. In the body of this video, I've got a link to prior episodes. This channel is really dedicated to those that are self-employed, small business owners. And hopefully this time of the year, mid-year, small business owners are remembering to take some time off. So if you're not tuning in now, you're on the beach, tuning in later. Hope you're doing well. Thanks for all the support. I think we're almost at this time, just a couple hundred subscribers away from hitting 80,000 subscribers, which is beyond my wildest dream. So I want to thank you for all your support, encouragement. Today, we're going to cover a number of issues. So here's our agenda of what we're going to be talking about. I'm going to run through, like I normally do, any new IRS news. Don't snooze on it. A couple of neat things that are going on. I'm going to talk about top 10 ways, in essence, to pay zero taxes. Understanding the LLC for tax purposes. I'm going to throw in a little story. Met today with a great CPA from the East Coast. We met for, I want to say, a little over 4 hours. So just share a little bit about that. This week's client advice. So I'm going to share with you some things that have come up in these episodes, meaning have come up with my clients that you might find of interest. A quick Ppp Forgiveness update, quick ERTC update, which is the Employee Retention Tax Credit, which is $26,000 per employee. And then maybe we'll see, I don't know, come meet JJ the CPA. I have a crazy idea related to that, but here's what we're covering today. Real quick on the IRS news, and I know that it's like, well, why are we having to cover the IRS? We can go to irs.gov and click on that. And I would definitely encourage you to do just that, to keep current. But here's what's happened really just in the last week. The IRS has expanded what you can file electronically when amending tax returns. Now, many may be filing a 1040 NR, a 1040 SS, or a 1040 PR. But for tax pros out there, these are now able to be filed electronically from the amendment aspect. Also, you can still file amended returns for 2020 and 2021 tax returns. Also, the IRS has indicated actually by the end of this week that they plan, now I didn't read it as they're going to have all tax returns that were filed in 21 done by the end of this week, but they said the vast majority, they're really focusing in on trying to get completely caught up. Let me be clear about this. This is the returns that were filed last year that they still haven't processed, that the IRS has really made it clear they're aware that there is a backlog. They're working hard on it. They've dedicated a lot of staff. And the reason I bring it up is that if you are waiting still on something that you filed in 21, hopefully you're going to get your refund or results or a reply sometime in the next 4 weeks, I would say, with them finishing everything up. So if you're 4 weeks from now and you still haven't heard on something that you filed in 21, like in the calendar year of 21, then you may want to go ahead and do some following up because it sounds like they're trying to get really caught up. Also, there's a group out there called the National Taxpayer Advocate. And they're really there to represent taxpayers to Congress, to the IRS, to those that in essence are serving the taxpayers, which would include me, enrolled agents, CPAs, and tax pros. Now, the reason I'm bringing this up is the IRS actually has it on their IRS website, but they are indicating that there are concerns in the refund delays, as well as then what is being basically reported as poor customer service at the IRS. Now, why am I mentioning this, right? Because IRS might be the favorite organization for many to, for lack of a better word, beat up on or not be happy with. But the way I look at it is the IRS is made up of American citizens that are doing a job. Their job is to simply collect taxes on behalf of the government. And they are great people. They're good people just like you and I. And the only reason I really want to bring this up is that if you have a delay in your refund, be aware that you can check the status. Just go to irs.gov. Right there on the main page, you will see "Where's my refund?" ? Click on that. You actually now can see back not only for the current year, but back 2 years to see the status of that. Why am I bringing that up? Because if you're waiting on a refund, go and log in. It'll walk you through the steps. It's very simple. But if you don't see that your return has been received and you filed it a while ago, then you want to take steps to then either in essence, file an amended, but hopefully you're working with a tax professional that's going to guide you on that. The theme that I'm really kind of getting at right now is, besides just giving you what the IRS has come out with, is that we should be on the cusp, I think, of really seeing that the IRS is caught up in a lot of different ways. And why is that important to you? Because in about 4 weeks, if you are not seeing that the IRS is caught up on what you're waiting on, well, then you really probably would say it's time to take secondary action in following up with the IRS. Typically for us, that's by letter to the IRS as a tax professional. Tax professionals, be aware there is a tax practitioner hotline. So there's a direct phone number that you get to call as a tax practitioner if you're registered as such and you have your PTIN, which is right on the IRS website. Last thing I'm going to mention to you is that if you do owe taxes, it is always better to set up a payment plan if you can't pay it really in the immediate future. The benefit of the payment plan is it could avoid you having it reported on your credit. Also, then you're paying at least something towards what you owe, which does reduce down in the end overall penalties and interest. But the IRS has announced that it is increasing the usage and expanding how, when you call the IRS, using what they call a voice bot service, BOT, voice bot service. And that's expanded to now include setting up or modifying your payment plan. Now, for our clients, if they do need to set up a payment plan, we direct them to the IRS. You can make a payment plan really without having an account, you can make a payment without having an account, or you can set up a payment plan pretty easily. Just go to irs.gov. Right there on the main page, you're going to see make payment, and you're going to see your options of either just making a one-off payment or setting up a payment plan. Now, heading to our agenda, I am going to walk through each one of these, but here's what I decided. So if you tune in, I've done this a little different each week. I think that I've maybe narrowed down to how I want to go through our top 10 to pay zero taxes. So the thing I want you to note here is, for today, I'm going to walk through the top 10. I'm not going to expand on each one of these because I want to quickly get through it. I want to give you the ideas. Maybe this is enough for you to get these ideas and then go to your tax professional. And maybe you don't really want to watch the rest of it, right? You're not going to hurt my feelings. I'd love it if you'd stick around or come back and watch the whole episode. I'm here trying to put together good information for you as a practicing CPA. I've got 25 years under my belt with my own practice, and I've been doing tax services for 30 years, still doing it day to day. This is not what I do for a living. So all to say, I'm trying to put together good information from you, but I want to compact as much as I can at the beginning. Then I do want to talk to you about a few other things, and then I'm going to circle back and expand on each one of these. Now, I'm going to note to you, if you're not a subscriber to my channel, you haven't tuned in, you're never going to get anything hokey in my mind. I'm not going to give you information that is going to get you in trouble. And typically, you know the saying, if something sounds too good to be true, then it probably is. So having a good tax professional that has years under their belt is really the best way to accomplish paying the least amount of taxes or possibly zero taxes. So let's start with number 10. Be a real business owner in an LLC. So formalize your business, have a separate business account, have business cards or a website, and in fact, have a business, a side hustle. Convert whatever it is that you're doing to make a living into having your own business. It does open up the door to having a lot more expenses available to you, things that you're already spending money on. Number 9, being an investor in a business. Now, why? Well, as an investor in a business, depending on how you're paid out, it can then change the tax rate that you're dealing with. If you're paid out a dividend, that's paid potentially at a capital gains tax rate, which is much lower than ordinary tax rates. Also, as an investor in a business direct, so I'm not talking about in the stock market, but direct investment, not your brother-in-law's business, okay? Not your mom's business, not your sister's business, okay? I'm talking about you being an investor in a bona fide business that has a true chance of surviving. But many times in the early part of that ownership, as an investor, it's going to have losses, and you would be able to then deduct those losses potentially, and that would help reduce down your taxes. So in a lot of ways, that investment can become a deduction if that business does have losses. Number 8, do tax efficient stock investments. So if you were somebody and the only way you made a living was buying and selling stocks, now you may be a day trader, but if you were buying and selling stocks, you would be able to be tax efficient because we know that some stocks are up, some are down. So if you have stocks that you're selling and they're up and you have capital gains, the benefit of that kind of transaction is that if you then also have stocks that are down and it makes sense economically, and you sell stocks at losses, that wipes out your capital gains, yielding in essence a zero tax. No, I'm not advocating for you to sell stock to just have losses if it does make sense. But see, that is an unusual set of circumstances in the tax code, meaning you could have $1 million in capital gains, but if you also have $1 million in capital losses, they will be able to offset those. Capital losses also can be taken in addition to your capital gains, but only to the tune of $3,000 a year. What does that mean? So if you had $1 million in capital gains, but you had $2 million in capital losses, well, you'd be able to offset your $1 million in capital gains. And then in that current year, doesn't sound sexy, but you would be able to then take $3,000 in capital losses that are in essence more than your capital gains. So not a lot, but then the rest of that is going to carry over indefinitely into the future. So the reason I'm saying that is that if it does make sense for you to capture realized capital losses, realizing as in you sold the stock. No, I'm not advocating. Hear me. I'm talking about the tax angle. But if you have stocks that are down, don't expect them to rebound. You can harvest tax losses for the capital gain and then use them in the future. Number 7, have tax basis. Have tax basis so that when you have losses, you're able to deduct those losses. So that's part of the planning process. Remember, I'm going to circle back to these and go through these in detail. But number 6, put your vehicle in your business. Okay. So that means you got to have a business. You got to have a business that you can write your vehicle off. But under the current tax law, you're able to write off such a huge amount of the cost of the vehicle, some of it up to an immediate 100% deduction. We're going to talk about that. I also have a couple of videos that you'll easily find on my channel talking about deducting a vehicle if you want to go to some real detail on that. But you probably have a vehicle and you may not be deducting all that you can on it. Number 5, pay your kids, right? This is one of those that for whatever reason, it sounds like, oh my gosh, you're going to pay your kids? Get over this, okay? That is ridiculous thinking But yes, you can pay your kids. You're going to incur some payroll tax on that, potentially. Your kids are going to pay tax on it. There's nothing wrong with it. What's wrong with it? You listening to a hokey video on YouTube with somebody that's not a tax practitioner. All they did was read an article. They put together a video with some good clickbait that makes you want to listen to it. And then they're giving you hokey advice that's not based in reality on paying your kids. Okay. So I'm not talking about paying your 2-year-old $50,000 in wages. I'm talking about real life circumstances where this can make sense. And I'm going to talk to you about why. But in our top 10, let's continue. Number 4, max out your tax deductible retirement. So many that I've worked with in the past, for whatever reason, they're going to spend plenty of money on a vehicle. They're going to buy the best computer, the best equipment, right? Hopefully they're giving raises to their employees every year, and they put themselves last by not setting money aside in retirement. It's not the end all be all, but if you're not at least maxing out what you can put into your retirement that gets you a tax deduction, that is a first step in my mind. And when I say first step is this: there's no way with you maxing out what you can put into tax deductible retirement, it will even be enough for you to retire on. Also, when you put money into a 401k, a SEP, a simple, even an IRA, it does not have to go in the tax market, okay, or in the stock market, right? Does not have to go in the stock market. It can go in bonds. It can sit in treasury. It can be self-directed, okay? But don't go to some hokiness and then not, in essence, allow yourself to get the full deduction because you decided to do something else besides help for your own retirement. Number 3, depreciate tangible assets with special depreciation. Now, the special depreciation I'm talking about is twofold. There's section 179, it's just a code section. And then there's section 168, which is bonus depreciation. Both of these can lead to 100% immediate deduction of tangible assets that you're buying inside your business. And what does that mean? You could be financing, let's say, a piece of equipment that's $50,000. So you go to the bank, you say, I need to buy some equipment. They say, great, you don't even have to put any money down. We're just pay that vendor and you can start payments in January of 23. So in 2022, you would have signed a note, you would have bought the asset, it would have arrived, you would have placed it in service, but you would have spent $0 out of your pocket. But under either one of these code sections, you potentially can deduct immediately 100% of that $50,000 cost. I'm going to talk to you further about it. Number 2, own commercial real estate. Okay. Now there's a lot of videos out probably talking about this. There's some good information out there. There's misleading information. There's hokey information. Remember, as a certified public accountant, I actually have a duty to the public. It's actually part of my credentials, public, certified public accountant. So hopefully when you're getting information from a CPA, even if it's not your CPA, they're giving you information at least as of the date that something is being shared, that it is competent. It's something that you should be able to then take to your advisors. Hopefully it doesn't get you in trouble. But with that being said, commercial real estate has yielded many of my clients paying 0 taxes for many years. Now, it has required that they buy more and more commercial real estate, but we're going to talk about that. But also with number 2 and number 3, both talking about depreciation, what I need you to know is that in 2022, something is going away related to the 100% bonus depreciation. That is going away. So stay tuned because I'm going to talk further about this with you. And then number 1, the way to pay 0 self-employment taxes is by electing for your LLC or your entity to be taxed as an S corporation. I have a number of videos related to that. Basically, you formalize your business as an LLC with the Secretary of State. That's your legal entity. An LLC does not tell the IRS how you plan for it to be taxed. Elect for it to be an S Corp, and you're going to pay 0 self-employment taxes. So if you have a Schedule C right now or a Schedule F, and you are then self-employed and you net $100,000, you are going to pay $15,000 in self-employment taxes. If you were simply an S Corp, you would pay zero of that self-employment tax, which is huge. Now, really, when we talk about paying zero taxes, what we're talking about here is a culmination of all of these things put together. It's following the rules, following the law, following what the IRS has given us as guidelines and procedures, and knowing how to, in essence, mix those things together. The only way you would pay zero taxes otherwise is that you wouldn't make any money, that you would be somebody that, in essence, maybe what an American would say would be unsuccessful. Now, I could probably point to many successful people that don't make any money, but I'm talking about monetarily, I'm talking about with money, and I'm talking about, in essence, financially. Now, maybe you can find some kumbaya that somebody's rich otherwise, but I'm not talking kumbaya. Here is a CPA, and I'm talking about money. So if you don't make any money, then you don't pay any taxes. The other way that you can pay zero taxes is just to break the law, in the sense that you're committing fraud. But in essence, when you hear about paying zero in taxes, it's most likely because you did a lot of careful planning. You probably had a big year where you either made investments into entities or you had big purchases in assets inside your business. You had things formalized. You did the planning. And see, in dealing with my clients, and this is going to lead to the client advice that I'm going to talk to you about here in a little bit. In dealing with my clients, our goal would be to pay zero taxes, but sometimes that's not achievable, because the thing I want you to remember is that whatever you do spend in your business, or if there are individual tax deductions that you can take, you still had to spend the money, right? So let's say that you're in a blended tax rate of 30%, and you spend $10,000 on some tax deduction, whether it's charity and that's allowed, whether it's into retirement or buying some kind of equipment. You had to spend 10 grand. That 30% tax rate in this example saved you $3,000 in taxes. See, for you to pay zero taxes, in essence, you would have to be spending all of your money. So if you only brought in 10 grand and you spent 10 grand, well, then your effective tax rate is zero. So it is very difficult to pay zero taxes. That's not really how you should judge your tax professional. What you should judge your tax professional on, CPA, EA, your tax pro, is the planning, the things that they're doing with you, not during tax time. See, when we hit January 1st, it's all too late. So whether you're listening to this year, next year, early next year, 10 years from now, it's about the planning. And that's why I'm glad that you tuned in and are listening to some of the information that we're walking through here. So I also want to visit with you about somebody I got to visit with today. And I think we have a photo just taken probably not even an hour ago. I believe he's traveling back home right now. My good friend, Matthew, good new friend. Now, we did connect during the pandemic all the way back in 2020, a fellow CPA from the East Coast, and we hit it off. We've got some emails that we send back and forth, keep ourselves kind of motivated and having some fun. But he was going to be in Missouri this last week and reached out to me and he said, hey, is there any way I can pop into Oklahoma and visit with you? So this is somebody that's got around 20 years of experience practicing CPA. We had a great time kind of going through a number of ways to manage a practice and kind of sharing notes. And he's got a very successful practice, but it was just great to sit down with a fellow CPA, fellow, I'd say sole practitioner, meaning we don't have big practices. He comes from a background of working in the national firms. And so he's got a unique approach, I think, to working with his clients. So anyways, Matthew, great to visit with you today. Appreciate it. Showed up with a Starbucks, one of my favorite drinks from Starbucks, which is much appreciated. Took a few pictures together, gave him a copy of my book, and we visited from about 10:30 a.m. to I think actually about 3 p.m. So we spent a lot of time together. So Matthew, thanks for coming to Oklahoma today, being a fellow CPA. I just said, you know what? He offered to pay for my time. I said, Matt, you don't need to pay for my time, my friend. You're coming all the way to Oklahoma. Now, I don't know that I can offer that to everybody. This is somebody I've been dealing with for a long time. But that also leads into what I want to share with you on this week's client advice. And so when we're dealing with clients, meaning tax pros, meaning you, if you're a small business owner, really what's key here is for you not to sit around and wait for your tax pro to call you, okay? We as tax pros don't know when there is some event occurring in your life or in your business that really could provide an opportunity for you to save taxes. What we need is for you to be more interested in your taxes than we are, right? I've heard over the years, given that I've been doing this for 30 years, well, I've hired you as the professional. I want you to come to me with ideas. No problem. And I do that with my clients. I reach out to them, even if I haven't heard from them, to set up a time to visit, check in, what's going on. But regardless of that, you need to reach out. They're your taxes. You're the one paying this, in essence, your taxes. So really, you should not at all be judging your tax pro on how much they charge you. Because in my mind, if you're getting charged appropriately, you're saving, you're planning, you're saving not only taxes, but probably saving in many other ways related to your business. And so the reason I say that with this week's client advice, so I had a client, Roy, that reached out to me yesterday, in fact, and he said, hey, listen, I'm looking to buy some real estate in Colorado, and here's the dollar amount. Here's a link to it. How should I go ahead and structure this? I do want to put in an offer tomorrow. I would like to be able to just know how I'm going to buy it. I do think I'm going to go through the financing through Jason, who's a banker that we work with. Note, I'm not using anybody's last names here. But long story short is that quick communication leads to now us having a good, competent discussion on how to go about this. So when I talked with Roy, I said, hey, Roy, a few questions for you before I get any kind of answers back to you is, do you plan to rent it out? Do you plan to use a service to rent it out? How soon do you plan to rent it out? Is it already built or are you building it? Do you expect that you're going to be there to, in essence, enjoy this piece of property in Colorado? How many days do you project in a year that you're going to be out there for you and your family to enjoy? What do you think the costs are going to be to furnish it? What do you think the costs are going to be for any improvements? Is there a builder involved? Is there somebody that has given you an appraisal? Or do you expect that it will be appraised? Do you have an attorney in Colorado? So the reason I'm asking all those questions is that for me to formulate some advice to him on how we go about it, I need to gather up more information. So with Roy, we've been dealing with each other now about 15 years. So I didn't need to have a long discussion with him because I'm already very familiar with his tax picture. We get together on a regular basis, but we're going to meet back on Thursday. I was able to tell him quickly how to go about purchasing it, but he doesn't plan to use it for, in essence, renting it out right away. He does need to do some improvements. And so I had said, well, you know what I think you do to start is why don't you buy this thing personally? Then when you decide that it's going to be rented out, you can quick claim deed it over to an LLC. Part of that is that building or what he's looking to buy is going to go quickly. The real estate market is moving swiftly and quickly. Interest rates are going up. So it doesn't make sense to then, he doesn't have an attorney in Colorado, didn't think he did. I don't know an attorney in Colorado. So we would need to find an attorney in Colorado, set up an LLC, then get an EIN, do the operating agreement. It also lengthens the process of buying the property and he needs to move on it quickly. But by knowing step one, step two, we know that once he has the property ready, that he will rent it out. And at that time, we would set up the LLC. And if he is renting it out and he's using it less than 14 days in the calendar year, then we know what set of rules we get to follow. He'd be able to write off everything really that he's buying to furnish it, the spoons, the utensils, the bedding. He'd be able to depreciate it. He might be able to get some bonus depreciation depending on which year he is placing it in service. He wouldn't get Section 179. It is residential. See, I want to give you a bunch of examples. So now if you're listening and you're taking some notes, I've given you enough information of what you would want to now tell your tax pro if you were in those exact circumstances. But I'm going to expand on this a little bit more when I go back to the top 10 and I talk about the depreciation and also being in real estate in terms of the tax benefits related to that, and those benefits being that they're reducing down your taxes. Now, I do want to give you a quick PPP forgiveness update, and it's really this. I want to make sure that when you go to file for PPP forgiveness, that you go to the website for the SBA. It's really simple. Go to sba.gov. After this, I'm going to give you some links in the body of this video that will take you directly to the PPP forgiveness application page, but you should be able to find it really on your own. And on that page, you're going to find a link to those banks that are participating in a direct filing with the SBA, meaning the bank will then not be involved in your PPP loan forgiveness process, but you will go directly to the SBA and you will go through their portal to, in essence, put in the information and request the PPP forgiveness. Now, you won't have a choice. The bank's either doing it or not. And if the bank is not involved in that program, then you will go through the bank. But it would make sense that if you haven't heard from your bank, that you do now reach out to them. It would make sense for you to start the process, if you haven't already, to getting PPP loan forgiveness. Why am I saying that? Well, we're really in the time frame now that your loans are, or the loan payment is no longer going to be deferred. So with PPP, take the date that you got the money in 2021 for round 2, and you're going to take that date of disbursement plus 24 weeks. That's your covered period. Then from that date, add on 10 months. And that is how long the PPP loan payments are deferred, meaning that's how long you have without having to make any payments on your PPP. Now, you may be saying, well, wait a second, I thought that PPP was forgivable. It is, but you need to file for PPP loan forgiveness. The thing I want you to note here is that if for whatever reason, the other reason of bringing this up is that you do get some kind of notice from your bank and it says, hey, you haven't filed for PPP loan forgiveness, so you need to start making payments. Don't panic, but what I do want you to do is make that payment. Guess what? You're going to get it all back plus the interest. But what you don't want to have happen is you get in arrears or get delinquent in a loan with the bank and then it get on your credit report. Listen to last week in episode 8, I talk a lot about banking, what you need to do to be prepared, but this is one of them, protecting that credit score. But the thing to note here is that most of the time, the PPP loan forgiveness application process is going very quickly, but you still don't want to delay in making that payment. So make the payment on it, get your PPP loan forgiveness application in. Once it gets approved, and hopefully it will, the bank is going to receive the money from the SBA for the loan. And then because it was forgiven, the bank is going to return to you whatever it is that you paid in principal as well as the interest. So when we're then talking about the ERTC, the Employee Retention Tax Credit. Now, I'm going to plug this for just a second. If you've not gotten the Employee Retention Tax Credit, I do have a seminar. There's a link in the body of this video. You get instant access to it. I walk you through A to Z on how to get the Employee Retention Tax Credit. Don't hire someone you don't know to do this for you. Do not hire somebody you don't know to do this for you, because there now are a lot of those that are taking advantage of you. And one of the ways that they're taking advantage of you is charging a percentage, an unreasonable percentage of whatever your credit is as their fee. As a CPA in 30 years, I've never done that. It's actually not allowed for CPAs, and except for in the most rare of circumstances. Now, with that being said, you want to first turn to your tax pro to see if they will help you with this. If they say, hey, I'm not doing anything with the ERTC, ask your tax pro for a referral. If they don't have a referral, maybe consider getting a new tax pro and tell them I told you to say that. Your tax pro should be, in essence, your first one to help you go and get an x-ray. What does that mean? If you go to your general practitioner doctor and you say, I think I might have fractured my arm, and your doctor says, we don't do x-rays, and you say to your doctor, well, can you refer me somewhere? If your doctor said, well, I don't know where you can go get an x-ray, do it yourself, go figure it out. Go buy a fly-by-night. Just go by somebody that happens to have a website that includes ERTC or x-ray in it, right? I would tell you, why are you with that doctor? Get rid of that doctor. Doctor's time for them to retire or do something different, okay? Your tax pro should be a resource for you. If your tax pro goes, I don't know, say, well, I need you to find me a resource because I want to deal with somebody that you at least know. They'll be able to call around, okay? At the end of the day, though, I want you to know this. The ERTC is still alive and well. Let me be clear on this because somebody had a question about it in one of the comments on one of the recent videos here. The ERTC is not available on payroll paid in 2022, okay? But the ERTC, the Employee Retention Tax Credit, which is up to $26,000 per employee, is still available on wages that you paid from March 19th of 2020 through September 30th of 2021. Now, it is available in fourth quarter of 21 if you're a recovery startup business, which is a business that came into business after February of 2020 and had at least, or had no more than $1 million in gross receipts in the prior year. Most of you may not be that. It does require payroll. But let me tell you this. In 21, it is way easier for you to qualify than you think. Do not assume that your tax advisor who does your income tax return, either for you personally or your business, has looked at this. And the reason why is that many of those tax pros don't do payroll services. The second reason is they may not have your financials on a quarterly basis, which then is used to determine if you qualify. Because here's what I want you to hear. If your gross receipts are down at least 20% in first quarter of 21 compared to first quarter of 2019, and you heard that right, 21 compared to 19, your payroll, potentially, if you have 500 or less employees, your entire quarter's payroll is potentially eligible for the Employee Retention Tax Credit. Don't go it alone, okay? But if I were to tell you any small business, right? Pretty much any small business, maybe a small business that does $100 million, because that's not a small business. Maybe a small business that does 25 million. I don't know, even a client that does 25 million still would think it's significant if you just filed some paperwork and you could get $7,000 per employee, let's say in quarter one. And if you have 10 employees and it's 70 grand, how much time would you spend finding a professional that didn't charge a percentage? How much time would you spend gathering the info, going through, potentially even if you had to, filling out the forms to get 70 grand? Don't even tell me that you wouldn't spend at least a month. Are you talking 70 grand? How much do you make in a month? Wouldn't you spend 160 hours? It won't even take you that. Here's my point. Stop ignoring this. Stop thinking that somebody else figured it out for you, and stop, in essence, assuming that you don't qualify for it. Get with your tax pro and figure out why you don't qualify. Get them to tell you why you don't qualify. Don't call and say, do I qualify? Call and say, tell me how I don't qualify for this. Okay. Now here's the good news. You have 3 years from the original date of your Form 941 being filed to go and amend it. And if you're like, oh, what's a Form 941? What's the original due date? Here's what I want you to hear. None of that is in year 2022. Okay. Any of these 3-year dates that I'm telling you that you're like, well, when is the date? When is the date? It's in 23. If you're listening to this video in 2023, I'm going to put in the body of this video those specific due dates. But if you're watching it in 2022, you need to know this. You can get it. Okay. It's 3 years from the original due date. Some have all the way until 2024 to go and get this on those. So don't pass it over. Now, I want to talk about LLCs and how they are taxed. Okay. And I'm just going to walk through this quickly because I do talk about these issues each week. I talk about S Corp, so I don't want to get redundant on this. But here's what I want you to know, because I still have clients. And even 2 weeks ago, I was visiting with a client, and we were meeting with a group of their advisory group, right? So we have the attorney, we have the financial advisor, we have the banker, we have me, we have their CFO, we have the two owners, we have their general counsel, we have the CPA involved that's doing their financial audit, and myself, and then also their controller, right? And what the client was answering was a question from one of the advisors. And they said to the business owner, the main business owner, one of the two main business owners, they're like, hey, in that entity that we're looking to set up in your expansion, how will it be taxed? Now, you got to know, in a big meeting like this, questions first go to the business owner. The business owner will then decide if they want to defer to the expert that's in the room. So this question is being asked to the business owner. Hey, so of your new entity, your expansion, how do you expect, or what do you expect it'll be taxed as? And he said, oh, well, we're gonna set it up as an LLC. Now, I'm going to tell you this. We all had a chuckle in the room, okay? And even the business owner had a chuckle. You know why? Because I've been dealing with this client now at least 15 years. And every single person in that room, we've been dealing with each other for at least 15 years, some longer than that. And they already knew the answer, which was an LLC does not tell you how something is going to be taxed. An LLC is only your legal formation. Now, part of the reason it was a chuckle is that this is a business or set of business owners that they have many businesses. And so we've talked about this a number of times. With that being said, I want you to know this. An LLC can be taxed as a partnership. Okay. I think we have a banner on that. Can be taxed as a partnership. Amanda?
No, sorry. Thought I clicked it.
So it can be taxed as a partnership. When would you want an LLC taxed as a partnership? I would say rule of thumb is if you're going to invest in a company and you're not going to be involved in that. So hopefully it's not your brother-in-law's company. I love your brother-in-law. Your brother-in-law is awesome. I enjoy them at the birthday parties. They're a lot of fun throwing kids around in the pool. They really cheer for your kids at the games. I love your brother-in-law. But your brother-in-law most likely isn't a good place for you to invest your dollars unless you do exactly what your brother-in-law does and you're going in business together. But for you to invest into a business, whether it's, wow, that's a good investment to directly put dollars in. I'm not talking about Walmart. I'm not talking about in the stock market. I'm not talking about into bonds. I'm not talking about what you would do investments with your broker, okay, or on any of the online services. I'm talking about you sitting with somebody eye to eye and you say, wow, that's a good business idea. I'm going to invest in that. Okay. I'm going to give you 10 grand or whatever the number is. You would want to own that in an LLC. Why? Well, that's your legal formation. It's going to separate that investment from you personally. So if you invest 10 grand into a business personally, maybe somehow you could be held liable personally for something this business was involved with, where if you have an LLC, you've provided a buffer. But see, that's on the legal end. So an LLC taxed as a partnership makes a lot of sense if you're going to be not involved in it. Why? Because an LLC that you're actively involved with, that net income is subject to self-employment tax. Well, that makes no sense. You would be then voluntarily taxing your income at an additional tax rate of 15.3% for no reason. So an LLC partnership is also really good if you're going to own real estate. Now, what does a partnership also require? A second owner. So you would need to talk to your lawyer about who would be the second owner, go through those. But when I'm talking about the taxes for my clients, if they're not going to be involved in that business day to day, and really when you own real estate, it's rare that you are going to be involved day to day as much as you say you're going to be, unless you own 40 properties. It's probably not truly day to day. But with that being said, real estate investments, as well as then indirect, what I call indirect investments, not involved with that company that you're investing in. And the reasoning why is all the flexibility of the partnership for tax purposes. You can have different percentage of ownership, different percentage of how you split profits, how you split losses, different percentages of who has to put money in. Many times when you're investing and you're not going to be actively involved, there could be loans involved. And if you're then signing off on the loan, it can then give you tax basis. I'm going to give you a little hint and a wink here. Part of the reason I'm setting up the number of things I'm talking about is that when I circle back to the top 10, you're going to see how a number of these topics I've talked about are going to then, in essence, come to light in my expansion of the top 10 that I just talked to you about. But with a LLC tax as a partnership, if it's going to have losses and you want to be able to deduct the losses, you got to have tax basis. Tax basis is to the extent of your investment into that entity. And also you can have what's called at-risk basis, which is another type of tax basis, which means that you're at risk. What's at risk? At risk for a loan that you personally signed off on. But see, a partnership is the only entity compared to an S Corp or C Corp that gives you that advantage of having at-risk basis to deduct losses when you sign off on a loan personally. That's not available in a C Corp or an S Corp. But really the number one thing, if I'm talking to a client, so when I was talking to that client earlier, and they're going to buy some property in Colorado, we are going to set it up for an LLC to own it once he's ready to actually rent it out. But we will tax that as a partnership, and we will have his spouse as the other partner in it. But we will tax it as a partnership. They're not going to be involved in the day-to-day. We do want the flexibility. They are going to be signing off on a loan personally. There potentially will be losses, and we want them to have basis to be able to take those losses. Now, for my fellow tax pros, you know that may be a passive loss, but you still have to have tax basis and or at-risk basis to even allow a passive loss to offset other passive income. Now let's talk about an LLC taxed as a C Corp. So an LLC taxed as a C Corp. So an LLC is still an LLC. Now a C Corp is really for those that truly are in that realm where they're going to have, let's say, more than 100 owners. They plan to have a lot of investors. The owners are really, in essence, not involved in the day-to-day. This is a type of business that's going to go public. It's something that's going to be sold off. And the reason for that is that you really aren't looking for a C Corp to have tax advantages when it's closely held. So if you have 100 or less owners and you decide to be a C Corp and you're now distributing out dividends, well, maybe an advantage, because if you have 100,000 and everybody's then picking up $1,000 dividend, assuming everybody has the same percentage of ownership, well, the dividend can be taxed at capital gains rate. But what you would be ignoring is that up at C Corp level, that 100,000 of net income that was paid out as a dividend, that the owners then paid capital gains tax on, even if as low as 15%, or I should say as low as 0%, but capital gains rates 0%, 15%, and 20%, and potentially subject to the 3.8% net investment income tax. But dividends are not tax deductible to a C Corp. So the money left the C Corp no longer has that money. It paid it out, but it doesn't get to tax deduct it, which means that C Corp would pay 21% in federal tax on that net 100,000, even though it was paid out. You start adding that up, and overall, you paid a lot more in tax. So for a closely held business meaning the owners are really working in it. They're relying on the income of the business for their livelihood. It's really less of an investment and more, in essence, what they do for a living. You're overall going to pay more taxes. That's why for tax purposes, you really don't want to be a C Corp unless you have to. I was visiting with a group probably a couple of weeks ago, and they asked me, so it was 3 owners. They asked me, hey, we were just visiting with our financial advisor, and they said, maybe you guys should consider being a C Corp. I said, well, are you kidding me? What? Who's your financial advisor? Anyways, I said, well, let's get your financial advisor on the horn here. Let me really walk through this, because they should never say that again for a business that you guys have, the size that you're at, the way that it's structured. they're an LLC. So I walked through just what I told you. But part of the reason it came up is that when you're a C Corp, you more easily have to account for taxes on the accrual basis. And when the IRS requires you to do something, it's really never in your favor. Meaning, when they require you to be a certain tax structure, it is not typically in your favor. Same thing with being accrual. So if you have a business that is over a certain dollar amount, 26 million currently, they have to be accrual. If they're over that amount, they can't be an S Corp. They then can't account for inventory as an expense. All I'm telling you is when you're a C Corp, okay, you got a lot of things a little bit out of your control, which doesn't make a lot of sense. So I don't have any clients except one that is a C Corp. They set it up in the 70s. It's second generation. And the C Corp makes sense for the industry that they are in, but the overall tax structure is really what makes that C Corp kind of a non-issue because of the overall tax structure related to that. And if you're saying, well, what's that tax structure? It includes 26 entities. It's not anything that we would have any time to go through. But the thing to note here is that any small business owner, I don't know why you would ever be a C Corp. I don't know why you would be self-employed. Your really two choices are being a S Corp or a partnership. It depends on your ability to be involved. If you're actively involved, it's an S Corp. If you're not actively involved, it's a partnership, rule of thumb. So now let's talk about an LLC taxed as a sole proprietor filing Schedule C or F. When would this make sense? So Matthew, the CPA I visited with today, he and I were talking about this issue. When would it make sense to actually be a Schedule C or Schedule F? In my mind, it is so rare. I have at current only 2 clients that we file a Schedule C on, and in both circumstances, it is because the business is in the incubator stage. We are experiencing losses in the entity. So from that perspective, in filing a Schedule C, we don't have to worry about basis issues, meaning if they spent the money and there's a loss on Schedule C, they get to deduct it, where we would have some basis issues if they filed their LLC as either an S Corp or a partnership potentially. Also, when you then look at a Schedule C, it's already automatically considered non-passive. Same thing with Schedule F. The disadvantage to Schedule C or Schedule F is that the net income is subject to self-employment taxes. What are self-employment taxes? It's an additional tax on your individual tax return, meaning if you work for somebody and you get a W-2, you pay income taxes. If you are self-employed, you have income, you have expenses, and you have net income, and you pay income taxes on it just the same as if you also work for somebody else or only work for somebody else. Income taxes. But when you're self-employed, there was no Social Security or Medicare withheld or paid in on your behalf like it is when you're paid wages. See, when you're paid wages, Social Security and Medicare is withheld from your wages and the employer matches that. And what is that combined percentage? 15.3%. 7.65% is withheld and 7.65% is matched, 15.3%. Guess what? It's no coincidence that the self-employment tax is also 15.3%, and it's the same type of taxes. So when you go to file a tax return individually and you have a Schedule C and you have a Schedule F, that net income being subject to self-employment tax, you're going to take that net income times 15.3%, and then that will be additional tax on top of your income taxes. So I usually tell people, especially those that they're unsure about the success of their business, meaning, I'm trying this out. I'm going to set up the LLC. I'm going to tell that client, we're setting it up as an LLC. Get it done. Get an EIN. But let's then, in essence, file it on Schedule C or Schedule F. Because really, rule of thumb, this is for me, if you're netting about $20,000 or less, it may not be a break even for you. What does that mean? Well, you're going to have to file a separate return. There's a separate cost. You're going to need to have payroll, meaning there's going to be potentially payroll services. There's some additional things that go into setting up the LLC, attorney fees. So let's just say for grins that it costs about maybe $2,500 for you to have an S Corp in your initial year, all these different fees that I just talked about. Well, by having an S Corp that nets 20 grand, what did it save you in self-employment taxes? Because an S Corp is not subject to these taxes. It saves you 15.3%. Okay. So on 20 grand, it would have saved you $3,000. Well, if it saved you 3 grand in self-employment taxes, but it cost you 2,500, maybe 3 grand to do it, it's kind of a break even. And so it's like, well, is it really worth it? I would tell the client, yes, especially if you think the next year you're going to net more than 20,000. But for clients like, I'm not sure about this business, I want to give it a try, or I'm expecting heavy losses in the beginning, that's when it might make sense. So then once you're like, oh, I'm going to net more income than this, if it's a Schedule C, you're actively involved in it. Schedule F, you're actively involved with it. It's a no-brainer. You tax yourself as an S Corp. Now, we're talking about an LLC filing a Schedule E. So this would be another way to say you're a sole proprietor. That just means one owner, right? So taxed as a sole proprietor, but filing Schedule E. What is that? That's you owning real estate, okay? But there's only one owner in it, you. So you don't have to file a separate return. Why would somebody do this? Well, I have clients that they just have one residential rental, or they have some commercial real estate, but it's not significant. It's a low investment, maybe 50 to 100,000. Maybe that's something that's really just a storage unit renting out 3 sections. And on that, we go, well, I probably would still tell the client, you're going to have, no, 100% I'd tell the client LLC. I'd probably tell the client, let's still do that in a partnership. But if it's low in terms of the costs and the transaction, there's not much to it. It's kind of a break even. I say, you know, it might just be easier to file it on Schedule E. So why set up the LLC? It's again what I told you at the beginning, that liability separation protection. So with that being said, when we're now looking at who should file Schedule E and have an LLC, it would be somebody that's in real estate, but maybe really just it's a hobby almost. Like, I'm just doing one, or I bought this property and my kid's going to live in it while they go to college, and then I'm going to sell it. Now, if you're getting into really owning real estate, then an LLC really as a partnership makes a lot more sense. Then lastly, let's talk about an LLC taxed as an S corporation. So an LLC taxed as an S corporation, it can have one owner. With that being said, many will say, well, I'm an LLC single member, or they say I'm a single member LLC. What I want you to remember is all that means is that there's one owner, because a single member LLC can be an S Corp, it could be a C Corp, it could be filing Schedule C, E, or F. The only thing that a single member LLC can't file is a partnership, because you need more than one owner. But the S corporation is really for those that are going to be actively involved. You would want to have an S Corp. Why? Because the net income from the S Corp is taxed at the individual level, but not subject to the self-employment tax. So you take somebody that files a Schedule C and they net 100 grand, their self-employment tax is 15,300. You take somebody and they have an S Corp and it nets 100 grand, their self-employment tax is 0. Now, why wouldn't you be a partnership? I'm going to just repeat this because I said it earlier. Why wouldn't you be an LLC taxed as a partnership if you're actively involved? Because the net income is then subject to self-employment tax for a partnership. So let's just sum it up. Small business owners, you ready for it? It's pretty dang simple. Now, when I say it's simple, it doesn't mean now you go and do your own tax returns. Hire a professional, okay? But it's simple, in my opinion. Client comes to me and they say, I'm going to get into this business. I say, are you going to be actively involved? Ask enough questions to know that. No, I'm not going to be actively involved. We're going partnership. You're going to be actively involved? Yes. We're going S Corp. Boom. You're going to be an LLC no matter what. Now, I'm going to do something a little different here because I do want to circle back and I do want to talk through the top 10. But I'm a little concerned that if we keep going, people are going to see this video and go, oh, I don't want to watch that video. That is too long. So we're going to do something unusual. And that is we are going to We're going to end our live here, and we're going to start another live here in about 5 minutes. So what I want you to know this is we're going to wrap up the small business toolbox with JJ the CPA. But before we do that, I want to make sure you note that I do offer continuing professional education, pretty inexpensive. I got a link in the body of the video that you can check that out. The other thing I want you to note is that if you are interested, because I'm putting it together, it's an idea I came up with after I met with Matthew, the CPA, today, and after he left, is that putting together some kind of summit or forum here in Oklahoma City that I will lead. I'll have it at low cost, but I haven't really fleshed it out. More what I'd like to know, because for those of you that are tuning into the live, those that have made it to here, that's why I waited to the end. And I love all my subscribers. I love everybody that supports my channel, everybody that tunes in, all the wonderful emails and support and letters. I appreciate all of that. But probably if you've made it to here, you're really on board with JJ the CPA in terms of what I'm putting out there. And so I'd like to know, would you be interested in something like that? If I hosted it, let's just say that it's $197 to come for the day. It would count as CPE. Let's say it's 6 hours of seminar that I would be putting on, in person. There'd be a group. We'd probably limit it to, maybe 50 people, 100 people. Obviously I'd have some cost to that. But would that be something you'd be interested in? So email me at jj@jjthecpa.com. Amanda, I forgot to tell you to put that on a banner. Maybe put our email in a banner real quick. jj@jjthecpa.com is my email. Email me, and maybe just to make it simple, in the regarding line, you can say yes. In the regarding line, you can say, I'd love to come to a summit. In the regarding line, you can say something that lets me know you would enjoy coming to Oklahoma City, meet me, get some seminar not one-on-one, I guess it'd be 50-on-1. Would that be something you'd be interested in? Because if we have enough interest, we may put it together. In talking with Matthew, he was like, gosh, what would be neat is if we could have a group. And I said, well, guess what? I have a group already, but maybe I should put together something that's not a 12-month group. Maybe I should just put something together we can invite people to annually. And the other reason I'm bringing it up is that this month coming in July, with my private consulting group, if you will, Group 51, I'm inviting all of them to Oklahoma City. And so I'm looking forward to them. We got Coach's Pit Barbecue that's coming as well. Not going to tell you when because it's private. It's just open to that group. But that seems like maybe there could be some interested in that. So guess what? We're going to go live in 5 minutes, and I'm going to go back through in detail this top 10 in essence, reducing your taxes maybe down to zero, because I think it's going to take a little bit of time. And I don't want to then extend our episode 9, much longer than this so that people will tune in. So get ready, take yourself a quick break. I hope to see you back, but I just want you to remember one thing. I love you. I appreciate you. Don't you ever forget, you've never met a CPA quite like me.